Welcome, everybody, to another episode of the Dental Boardroom Podcast. As you listeners know, once a quarter, I like to do an investment market update. What are we seeing in the stock market? What are we seeing in the bond market? What's happening with the Federal Reserve? And just what's happening in our economy? And it relates to all of us listening. It does filter down into our own personal bank accounts one way or another. And so I like to do this with two of my colleagues. We have our Chief Investment Officer, Brandon Hobson, on the line. Hey, Brandon.
Hey, Wes, thanks for having me.
And then we've got Paul Lipcius, also on our investment committee, one of our key team members around our investment selection and asset allocation choices, highly involved with some of our clients' largest sort of investment clients. So he eats, drinks, breathes, and sleeps around the stock market, just like Brandon. So these two guys, I will openly confess, are more informed than I am on following the stock market and reading the Wall Street Journal. So thanks for being here, Paul.
Thanks for having me.
All right. The three things we're going to talk about in this episode are, number one, what's happening with the bond market and the Fed, interest rates, yield curves, yada, yada. And I want to emphasize to our listeners, to our dentists, that there's something a lot of people don't know, and you may not know, but the bond markets are they're like a leading indicator in some ways of where the economy is going. They tell certain stories that's different than the stock market, in other words. And so I want you, Brandon, and Paul to help extrapolate what is the story that the bond market is telling us right now. Secondly, we'll go over the stock market. That has its own story. I think it's a different story in terms of kind of what are the messages it tries to tell us versus the bond market. And then lastly, within the stock market, I want to look at international stocks. This is the year of international stocks. And I want to talk about why, and then ultimately sort of stick the landing by talking about what we're doing as a firm with our clients' assets. Our clients entrust us to make certain fiduciary decisions and oversight of their 401ks, their IRAs, their defined benefit plans. And we take that responsibility intensely and very sacredly. And so we're grateful for our clients for putting that trust. And we want them to know that we have a very deliberate, intentional way of allocating out their investments and making these choices. All right, let's jump into the Fed interest rates and the bond market. Recently, the Fed cut the rate by 25 basis points. It's about a week or so ago. And the current rate is at 4 to 4.25%. Brandon, what does this mean? Why? And do you think there's going to be more rate cuts down the road?
Yeah, good question, Wes. I think the current rate being at 4 to 4.25% puts the Fed still at kind of a moderate restrictive stance here. And so I think the neutral rate is, nobody really knows what that rate is, but I think it's somewhere around 3%, maybe 3.25. And so I believe there's probably going to be another rate cut this year, and that might come in the next meeting. The market is pricing in 2 more rate cuts this year. But I think a lot of people are thinking more like 1 rate cut is the better expectation here. There's just a lot of unknown with the unemployment rate right now. Both the denominator and the numerator are moving in the unemployment rate. So you've got the actual active recruiting for jobs going down, and you also have the working population decreasing due to immigration stance and stuff like that of the executive branch. And so I think there's a lot of unknown there. There's also some unknown on the inflation side. So that's why I think 1 more rate cut is the more likely scenario there.
Well, one thing for certain, we know our president is pushing aggressively for rate cuts. Paul, let's pivot this over to you. What does a rate cut mean for dentists?
Are you looking to buy or sell a dental practice? If you're a seller, how do you find a strong list of potential buyers? There's no MLS or Zillow for dental practice sales. In such a fragmented market, many dentists selling their practice feel discouraged. That's why I built PracticeOrbit.com. PracticeOrbit is modernizing how dental practices are bought and sold. It's a platform technology. Y'all know them: Zillow, Airbnb, Uber, and OpenTable, just to name a few. These technologies do 2 things. First, they help match buyers and sellers by centralizing the marketplace. Second, once the match between buyer and seller is made, these technologies help them navigate the sale to a successful close. Here are a few of the features inside of Practice Orbit. Users can determine a reasonable sale price for a practice in just minutes. All they need is the most recent business tax return. Practice owners can use the directory to find important service providers like practice brokers, attorneys, accountants, and bankers. Practice owners and their brokers can invite those service providers into the platform, so all parties are coordinating the sale together. Practice owners will have a beautiful digital listing of their practice, like a home on Redfin. And importantly, the listing will be anonymous, and personal information like your address, name, and pictures are only released after an NDA is signed and approved by you or your broker. Practice buyers can create saved searches to be auto-notified when new listings come on the platform that fit their desired specialty and location. And hey, dental practice brokers, you can list all your practices on the site for free. By doing so, you'll get access to Practice Orbit's large pool of buyers, all of whom have created profiles and saved searches to be auto-notified when new listings come for sale. You can use the platform to introduce your listings to a targeted set of buyers. Additionally, and optionally, you can use the platform tools such as a built-in NDA, a customizable LOI, and a workflow tool to navigate the sale from LOI to closing. In fact, you can manage all your listings on the system from listing the practice to NDA to LOI and finally to closing the deal. Create your free account today at www.practiceorbit.com.
Well, I think the most immediate impact we all feel, us as consumers and our clients, is really just overnight savings rates. So, what yield you're getting on savings when you're parking in a bank. You brought up a good point, which I want to remind our listeners, is the bond market tells us a lot as a leading indicator. And I think it's helpful to just kind of remind people of why is the rest of the yield curve is what we call it, that relationship between time and the rate you receive on your funds, or in the case of a borrower, it's the reverse, the amount you're paying. That's really moved by the market dynamics. So buyers and seller of bonds in the open marketplace. And that's typically what the day-to-day individual or business owner feels. So the movements in the 10-year treasury are what's going to move, for example, a 30-year mortgage more than the overnight rate, or that's what's going to move a practice loan or an equipment loan more than the overnight rate. So I bring that up and really want to lay this up for a segue, is that there's been a steepening. So despite overnight rates coming down, and so maybe we're getting 0.25% less on our savings, there's actually been a bit of a steepening in the longer end of the curve. And so I think our clients are not really going to feel much of the impacts of the Fed decision on that front. But I do think if you were going to go get a practice loan today versus even a quarter, 90 days ago, that might be a bit higher. Brandon, curious to see your thoughts on this. I mean, that steepening is generally a good economic indicator, that the longer term outlook is, more bullish, and therefore investors demand a higher return. That being said, I mean, where do you see the 10-year moving, or do you have an opinion?
Yeah, I do. I think that the 10 year is going to continue to move higher from here. I think that overall, when people think the Fed cuts rates, generally speaking, they think that that affects all interest rates along the entire curve, like you were alluding to, Paul. Um, that's not the case. Sometimes the longer end of the curve can move higher, even while the Fed cuts the shorter end of the curve. And so I think some of the things that are going to push the longer end of the curve higher is, like you talked about, Paul, the strong backdrop of the economy. GDP's actually coming in strong, and that tends to lead to higher longer term interest rates. Also, there's some inflation concerns that could lead to longer or higher long term interest rates. And so I do think you could see the 10 year continue to push to 4.5%, maybe even above that.
That's the dichotomy of the 10-year, right? It's like, on one hand, you could have it signal economic strength, and on the other, you can have it signal a higher fear of inflation. And so it is tough to sort of parse out what's positive and what's negative of that movement.
And just to be clear for our listeners, a 10-year, let's say treasury bond, a 10-year bond is going to be very different than a 1-year bond. The 1-year treasury bond is going to match something more like maybe your savings accounts at the bank that are getting some interest, or some short-term CDs. When the Fed lowers their rate, those things like the savings account or these 1-year bonds or CDs, those interest rates are typically going to come down. So you, as an investor putting your money in the savings account or buying these CDs, you're going to see less of a return on those in the short run. But the 10-year bond is different. It it's telling a different story about our forecast of the future. So the 1 year is more immediate, very tied to what the Fed is doing, but the 10-year, not so much so. And if the 10-year rate, if I go to buy a new 10-year bond and the rate on that bond is now giving me more, let's say it goes up to, I'm going to use exaggerated numbers here, but let's say it goes from 4 to 5% during a year period. What is that telling us about consumer forecasts on the market when the rate of a new 10-year treasury bond goes up?
Well, it's telling us a million different things. Brandon talked about inflation. It can also be a signal of economic strength. It can also just be supply and demand dynamics. If the Treasury is borrowing, kind of piling into the deficit, well, you're going to see an imbalance in supply and demand. And so I think any immediate movements, it's tough to get an exact read, but over time, the story generally shows itself forward. Now, in my opinion, I'm curious to hear what you guys think. I think it's an entirely mixed bag, because there are concerns about concerns and uncertainty, I would caveat, about the longer term inflation run rate, particularly with tariffs and some of these other newer developments, not new at this point. But economic data, particularly on consumer sentiment, is not exactly rip roaring. I mean, consumer sentiment is flirting with lows on the year. I think it's back to where the reading that just came out from the University of Michigan study was something like back where it was in March or April. And so we are getting a mixed bag of reviews, or rather readings on what that 10-year movement is telling us.
Yeah, I think from an inflation standpoint, the one thing that's interesting is that services inflation is actually 3 times that of goods inflation. And so if you were expecting, which by the way, overall inflation is at 2.7% right now. The PCE is 2.7%. That came out last week. That's the Federal Reserve's desired metric, or the primary metric they look to. And of that 2.7, only 0.9% of that was related to goods inflation. The rest related to services inflation. And so as far as tariffs go on the inflation impact, at least at this point, it's looking like that impact has been relatively muted. There are some that don't think the tariffs have filtered through the economy yet. So if you even assign a 50% probability that the tariffs have flowed through the economy, so there's another 50% yet to come, it's still hard to see tariffs at this point having a material impact on inflation.
Couple. Go ahead, Paul.
To my understanding, a lot of the tariffs haven't been implemented yet. Is that correct? Like, some are going into effect today, if I'm not mistaken.
Today's healthcare, those were just announced, I believe, last week. But for the most part, the tariffs have been implemented. And that's why I'm saying, even if you assign a 50% probability of that not being, so maybe 50% more to come, it's still hard to see that actual goods inflation is being impacted by tariffs at all as of today.
No doubt. And I think any of the drivers, at least as we're seeing it in the bond market, are maybe more centered around what's to come. Because even when they go into effect, you don't know. And I think it's more of a reading on uncertainty than the actual economic impact, right?
Yeah, I got a thought on this one. I think international trade contracts, you can't just flip a switch and turn it on. There's a lot of nuances, there's exceptions, there's got to be agreement, there's all that stuff. And then you got to execute it, which means you got to get the ability to collect on those tariffs now. You've got to set up sort of the the workflow or the process of collecting on those tariffs, registering it in the government books, all that stuff. It doesn't just happen overnight. My personal opinion on this is that the jury's still out on what the effect is going to be. Obviously, there's an inevitable effect because somebody is paying money. The question is, who is paying that money? And is it 100% US companies? Are they absorbing some of it? We talked about this in our last episode as well. I think that's where the uncertainty is a little bit. The other thing that I think is a lot of the big companies are sort of committing to reroute manufacturing in the states. But I think there's a lot of empty promises at this point. For example, at the tech dinner that Donald Trump had with all of those tech leaders a few weeks back, he went around the room and he said, "How much are you reshoring by investing here stateside in factories and whatnot?" And Zuckerberg was on his right hand, the chosen one, and he said 700 billion. But then it was caught in a hot mic afterward. He was talking to Donald Trump and he says, "I didn't know what the number you wanted, so I just said 700 billion." And that I think is indicative of a little bit what's happening right now, which is people making commitments in order to avoid pressure or avoid sort of the administration coming after them because they are clearly showing that they're coming after anybody and everybody. Nobody's exempt, not even Rupert Murdoch over Fox, which is clearly more favorable to the Republican side. Donald Trump will come after anybody right now, and the government is even taking ownership in some of these companies as well. And there's more conversation about that. But all that to say is that I think that what everyone is trying to figure out is what is the reality of these tariffs going to be? How much onshoring of manufacturing is actually going to occur versus how much is just stated? Because the onshore manufacturing doesn't happen in 3 months, 6 months, sometimes even during the term of a single presidency. It takes a long time to build out the infrastructure to truly onshore manufacturing. And then what happens to the pricing on whatever goods or services are being delivered through that rerouting of the supply chain. That's why I think the market just hasn't known yet what it's going to be.
Yeah. Yeah. I mean, I would say yes and no on that. I think that even if you do some onshoring and that takes some time, that you would expect to see tariffs start to show up in inflation while we have the intermediate time of not onshoring, not bringing jobs to the US. And you would expect it to be larger, really, because if you think onshoring is going to bring down inflation, you would expect the impact on current day inflation to be higher. That's just not showing up in the numbers. So, I mean, there is a lot of unknown yet to come, but the numbers aren't showing that tariffs have had a material impact on goods inflation up to this point.
And I think one thing that validates that comment, Brandon, is the fact that this year, how much have we collected in tariffs so far?
I'm not sure the exact number, but it's a lot. It's a significant amount higher than what it was in previous years.
I think so far we're at somewhere around 200, 250 billion, which is a healthy amount. And if you annualize that, it's probably going to be somewhere around 400 billion or so. So we're clearly collecting a lot of tariffs. So I said these things take time to sort of roll out the process. That said, it's already happening and the government's already collecting a lot in tariffs. And yet we're not seeing a huge spike in inflation, which sort of substantiates what you're saying, which is we don't know yet, but so far, nothing is indicating that there's going to be this sort of direct correlation between tariffs and inflation. It may be indirect and it may be softer, but I think we all agree that the end result is TBD at this point. Yeah.
And I'll tell you where I believe we're getting a pretty clear bond market reading is on the corporate side. Same general principle that the market sets the borrowing rates for longer dated bonds, but the way we read the risk profile of just the general business dynamics for public companies is on what's called the risk premium or risk spread. So if ExxonMobil's borrowing for 10 years versus the US Treasury borrowing for 10 years, what's the difference in those rates will tell you the risk premium. And right now that is razor thin. If you ask me, it's too thin. It's a very bullish indicator that at least this shouldn't impact corporate America. Maybe there's some overarching uncertainties around how it impacts consumer and inflation and the like. That's what really the treasury market's telling us, but we're not seeing a corresponding increase in those risk premiums. And so I think that paired with just general stock market performance evaluation is saying, hey, at least the signal is that, hey, corporate America is doing just fine.
So if I understand you right there, you're saying if the corporate interest rate, if I get a corporate bond and it's not giving me a whole lot more in return than a treasury, that means the corporation is very low risk because a treasury is pretty much as low risk as you can get. At least it historically has been that way. And so that risk premium goes down by saying, we believe corporate America is doing really, really well. And so we don't demand as much of an interest rate because the risk isn't as high there. Brandon, did you want to add to that?
Do you ever feel lost in your practice finances? And how about your personal finances? Ever wonder where your hard-earned money goes and why you're not seeing the financial progress you worked so hard for? If so, listen up. As a dental CPA and financial planner, I've created our company, PracticeCFO, just for you. With almost 2 decades of experience, PracticeCFO integrates great CPA services like accounting and tax with customized financial planning, both business and personal. Think of it this way. Our dental-focused CPA services give us the x-rays we need to clinically plan your global finances and be effective financial planners. It's a highly customized approach we call the CFO model. Historically, having a CFO or chief financial officer was an advantage of large corporations only. But today, Practice CFO gives that same advantage to private dental practice owners. As a client of Practice CFO, you'll be assigned one of our dedicated CFO advisors. You'll receive insightful financial reports each month, have regular financial review meetings, reduce taxes, grow your wealth, and feel more in charge of your numbers. Because we believe that in the competitive landscape of dental practice ownership today, you have to be an effective business owner, not just a capable clinician. Reach out to learn more at www.practicecfo.com.
Yeah, that's exactly right. So the risk premium on investment grade corporate bonds right now is about 0.75% over the treasury bond. And so you want that to be above 1%, typically 1.5%. It would indicate a healthy premium over a treasury. So the fact that those yields are actually going in the opposite direction, it's interesting. It could be a sign of that the market's placing very little premium or risk premium on that. It could also just be that they're overbought right now, and a lot of buying has been happening in the corporate space, and that could adjust over the next couple of months. But it's definitely something to keep an eye on. Another thing is that high yield bonds are yielding below 3% um, on that premium as well, and so they're typically above 3% is when you expect to buy high yield bonds and make some money on those. But when those yields get so compressed, the bonds become less attractive.
All right, let me ask you about this. The yield curve oftentimes is a leading indicator to what our outlook is on the future of the economy. And like you both said, there's a lot of factors that go into why the 10-year bond rate moves up and down. But one of them is just a general outlook on the economy. What happens to the 10-year and even the 30-year if we feel like we're going to go into a deep recession or something even uglier? What happens to those longer term curves?
Well, remember the economy is not the stock market, and so what we've historically seen with the yield curve is it actually so I just want to call that out because it's sometimes people kind of combine those two into one.
Meaning that if the S&P 500 is doing well, we think the economy is doing well.
Yeah, and that's not always the case in the short term. In the long term, those tend to move more in lockstep. And so it's not uncommon for the yield curve to start signaling a more bullish economic backdrop before the inevitable sell-off in stocks is coming. So I want to just caveat that. But I think a general steepening of the yield curve is bullish for the economic backdrop. It means that, look, over time, the Fed, so right now we're focused on what the Fed's doing in a more restrictive policy, lowering rates. But the 10-year is telling us that ain't going to last forever because we're bidding up or bidding down through pricing, but bidding up the interest rate that we want to get on longer term yields. So that's a more bullish indicator that over time the Fed will not be able to continue cutting. In fact, they might be raising in the future. It's sort of this discounting mechanism of what may or may not happen in the future.
Well, and the way that I look at it, go ahead and finish, Paul, and then I'll
Let
share
me
my
finish that comment that it's very common actually for that economic signal to happen before the any movement in the stock market, the general stock market occurs. So I don't it's a bullish longer term economic signal. It may or may not be a bullish stock market signal.
Got it. Yeah, when I think of the long-term curve, I think of that concept of flight to quality. If people are worried about where the economy is going, then they will move their assets to something that feels safer. And treasuries tend to be viewed as a much safer asset, obviously. And so if you have a lot of demand going into these 10-year or 30-year bonds, that's because people are concerned about the market crashing. And if there's more demand for those bonds, the interest rate's going to go down because they don't need to have as high of interest rates to attract the borrowers. And so if the yield curve isn't as steep or in a terrible situation, it gets inverted, is that not an indicator that people are concerned about where the economy is going when the long-term yields are falling?
No, it does, and that's kind of where we were for quite some time with an inverted curve, but now we are seeing that steepening. So it actually is the reverse. More money is flowing into stocks, valuations are getting pushed up, and some of that's coming out of the longer end of the curve, at least in the last 90 days or so.
Speaking of where the economy is going, gold. Gold is up 45% this year. It's at 3,890 per ounce. I think that's a record. Don't quote me on that, but
I will quote you.
it is way up there. What story is that telling us, guys?
It's hard to tell. It's definitely a flight to safety trade. Yeah, another thing that could be affecting longer term rates and definitely stock market valuations in the near term is that as the Fed does cut rates on the shorter end, these money market funds are going to pay less. And so you should see some big money flows out of these very short term liquid money market funds. And that's going to go into things like gold, bonds, if people are taking the flight to safety approach. And if they're bullish, you'll even see some of that flow into stocks.
Got it. Okay, let me wrap up this section on the Fed interest rates and the bond market. Base case right now, meaning the most likely scenario, is all indicators are pointing, they're not pointing to a recession anytime on the near horizon. However, there could be more easing, meaning lowering of interest rates in October if jobs soften further. Any final comment on the bond market and the Fed? All right, let's move into then number two here, the U.S. stock market. So several metrics are flashing warning signs that the S&P 500 may be overvalued. Factors such as AI hype, projected earnings growth, and lower interest rates appear already priced in to stock prices, reducing forward return potential and increasing correction risk. So here's my question for you: what key metrics are suggesting the broad indices in the stock market are overvalued?
I can go first on that one. I would say if I picked one key metric to focus on, it would be the trailing PE ratio. Um, and the reason for that is because it tells a lot. And so the S&P 500's trailing PE right now is over 30. For context, the PE on the S&P 500 has only exceeded 30 for extended periods of time during the 98 and 2002 dot-com crash, right? And so it's definitely high. It's elevated. And if you dig under the hood, a lot of the mega cap stocks are carrying that PE high. So in other words, there are a lot of stocks in the S&P 500 that are trading at a 15 to 20 multiple.
Which is a healthy longer term multiple, right?
Exactly, exactly. And so that's considered a healthy multiple and an attractive investment. But you gotta sift through that a little bit in order to uncover what's really value and what's overhyped right now or maybe overvalued. And so that would be my key metric, that at least the most important one that I'm keeping an eye on there, Wes.
Got it. Paul?
Yeah, and that PE ratio, what helps me, and I think is a simple way to look at it, is the inverse is an earnings yield. It's the exact same calculation flipped over. So if you have a 25 price to earnings ratio, that means you get $1 of earnings. You buy a stock for $25 a share, and you get $1 of earnings. That's a 25 multiplier.
Which is like a 3.5%, 4% rate of return.
Well, no, it's an exactly 4% rate of return, right? Because it's the inverse of instead of 25, one divided by it's instead of 25 times one is one divided by 25. So
Yeah.
the point is what we like to look at, not as an end all be all metric, but let's compare that to the risk free rate. So I can go lend the U.S. government something or some money over a 10-year period and be getting a mid 4% yield. But when I do that with the S&P 500 trading above 30, I'm only getting a 3-ish% yield. That the math gets a little more complicated, but the point is that yield is so low compared to a risk-free rate that it's signaling a huge earnings increase over time. Basically, the market saying, look, these companies are going to grow their earnings at a pace that Treasury just can't keep up with. And so that puts a lot of pressure on forward earnings. I think you said that correctly in the beginning, that when those multiples expand to this degree, we're pricing in a lot of growth, and a hiccup or two can really move stocks in a material way. So I think that's the PE ratio, like Brandon said, that's the number one thing you should be looking at, and that sort of inverse and how that compares to other opportunities is a really good way to sort of ground that thought process or dialogues, and I think is at the premise for investment manager decisions like a Warren Buffett and Berkshire being so heavy in treasuries and short-term bonds, is that spread, you have to be really nuanced to find the deals, because it's just not in the index right now. The index is so overrepresented with these high PE, high expectation names, that you can't just throw a random dart at a dartboard and find good value.
So what does this mean for your average investor who is maybe going index, throwing money in the S&P 500 is kind of their primary anchoring fund in their accounts? This is very, very common, right? The S&P 500 index is just it's something everyone sort of refers to, but the S&P 500 index, its composition has changed so much over the past 10 or 15 years with those magnificent 7, or even heard magnificent 10 with a few additional ones being added in there. And they're just outsized. Their effect is so disproportionately outsized the rest of them, it becomes less diversified in some ways by market share. How is this um, how is this kind of dynamic of the S&P 500 composition changing, Brandon, as our chief investment officer, our approach a little bit when we do use a lot of index-based options in our clients' portfolios?
Yeah, it's a really good question, a really good point that you make too on the S&P 500 not being very diversified. Right now, I think the top 10 stocks make up nearly 40% of that index. And so as an investment manager on the investment management side of the business, we don't want to necessarily follow an S&P index like that, that has the largest 10 stocks of the index making up 40% of the returns. So what we've done is we focus more on factors that drive our ETF or indexing approach. And factors would be things like dividend paying stocks. That's a factor. Value is a factor. And by buying into ETFs that have these factors as opposed to just a pure index ETF, you're able to reduce some of that risk that you would be getting if you're just buying into the S&P. Also, you can go by cap size, right? So you could do value, small cap, value, large cap, fundamental, large cap ETF. Things like that will help you balance that risk reward a little bit better.
Yeah. Paul, any thoughts on that?
I have plenty of thoughts on that. Yeah, I do think the index is incredibly frothy. if you wanna follow it blindly, get ready for some volatility. I think it's just priced in such a manner where you have to expect that. You have to expect some mean reversion on this. With that being said, plenty of underloved industries out there. Earlier in the year, we saw a really broadening of performance, and we've kind of gone back to the growth story of semiconductors and tech carrying the load over the past quarter or so. But I think there still is in staples and utilities, energy production, those sorts of spaces, a lot of good opportunities for the investment public. So taking a look under the hood, still a lot of good deals. You just really can't focus exclusively on the index in a market like this.
Yeah. um, when the indicators are pointing to overvaluation, like gravity, eventually it's going to come down if they're truly overvalued. And if we are using history as a measuring stick, then we will cycle back to something more to the mean. The question when isn't will it happen? It's when will it happen? And that's what's the most difficult aspect of investing. And it's why so many people lose a lot of money is because they're anticipating something correctly. Their timing is just off. And so they may pull their money out of the market, go to cash or go to short-term treasuries or CDs because they think the market is going to fall, or they go to gold. They think the market's going to fall. And then the market just keeps going on for another 2, 3, 4 years at a 10 to 12% rate of return. And then they're thinking, oh, well, I'm missing the boat. And so they put it back in only to find out within 6 months the market does actually crash. So that psychological aspect, that behavioral aspect of investing is the biggest culprit as to why people underperform the markets over time. Part of our job as CFO advisors here is to help our clients stay disciplined through the cycles and to remember that dollar cost averaging is real. When you're putting money in your 401k or your IRA or brokerage accounts every month, every year, every paycheck, you're just putting in little by little. And so if the market's falling, you're buying the stock at a lower price incrementally as it's falling. So when it does then recover or arrive at a higher price, you will have bought low and then you could sell high later. And so it's that systemization that is a very predictable forecast of what your investments will do over time. If you remove the emotions out and you are just you're just almost robotic about it. This is an area of life where returns are better when you're just robotic about it. And that's a key thing here at Practice CFO that we do. And we always start by preparing an investment policy statement for our clients. And then we hold pretty firmly to that investment policy statement that targets a given risk over time, not necessarily in the short run. Well, one of the areas of opportunities that's doing really well right now is international stocks. Why, Brandon, are international stocks just crushing it this year?
Yeah, so international stocks have pretty much outperformed or doubled the return of even the S&P 500 right now. I believe it's somewhere around double. So I think emerging markets are over 25% and international developed markets are up about 23%. Um, some of the factors driving that are the weakening dollar has really helped buoy international markets. Also, valuations are more attractive. So we're talking about the U.S. market being, kind of showing signs of being red hot or overvalued. There is a lot more fundamental attractive stocks on the fundamental and value factors, put it that way, in the international markets. Also, global growth has recovered not only in the U.S. but also in these other countries as well. And so, when international markets start to outperform the U.S. market, like what's happening this year, that tends to happen in cycles. It's usually just not 1 year or 6 months. This can go on for an 8-year period or more. And so that's really what I'm looking at here is to see if this is a period of a rotation into international markets that could be sustained for the next 5 to 10 years. And if so, we want to keep at least 20 to 40% of our clients' portfolios exposed to international developed and emerging markets.
Agreed. One thing we always have to have conversations with our clients about is that we are diversified for a reason. And when the Mag 7 are are outperforming dramatically the rest of the market on average, a lot of our clients know about Apple, they know about Nvidia, they know about Google, they know about Tesla, and they're investing money in this, or they hear about their friends are doing it, and here we are in this much more diversified portfolio, which is going to underperform in those years, which have been very consistent in the past number of years, that those top stocks are outperforming. However, like Paul said earlier, forward earnings is there's a ton of pressure on these companies to monetize what is their current stock price. Incredible pressures. And is it even possible for them to deliver the value that would be required in order to produce that return to those investors over time? Jury's out. I mean, AI is it's hard to tell with AI. This Bill Gates said that when it comes to technology, we tend to overestimate what it will do within a 2-year period, and we tend to underestimate what it will do in a 10-year period. And we're sort of coming up on, I don't know, year 2 or so of AI. Have we sifted through all of the fog of AI to understand what is it truly intrinsically creating by way of efficiency and gains within businesses? I think, and I heard a research study on this, that so far businesses are spending more money and resources trying to figure out how to adopt AI systematically than the gains that they're getting. And so the real net value out of AI has not emerged yet. So the jury's out, though, because no doubt it will. It's just the jury's out. What's the timeline on that ROI of AI, and what is the ROI going to be? Because the forward earnings on these big companies, all those companies I mentioned, are all very heavily invested and dependent on AI at this point for their future earnings. And so that's just what we don't know. And I just wonder if there's not like a lot of money moving into gold. A very strange statistic is that the amount of hamburger helper being purchased right now is going through the roof, which is this sort of unusual leading indicator that people are suddenly getting concerned and really frugal at the same time. I just wonder, are we going to be able to sustain what is this expectation and forecast that's in the stock market? And if not, what is that gonna mean? But I will say for Practice CFO, we've always been diversified, which means we've always had international. We've always had a broader exposure to the S&P beyond those top 7 that consume 40% of the returns. And we've always had value stocks, and none of those are value stocks. Correct me if I'm wrong, Brandon, but those are all growth stocks. But in the long run, value stocks outperform growth because value stocks are more directly tethered to the intrinsic current value of earnings that they're dishing out. And so it's a lot more predictable, even though it's less sort of popular and sexy, so to speak, as an investment option. All right, guys, any final comments on the stock market, the bond market, and what we're doing as a firm to help our clients manage their assets?
No, I think the message is consistent. It's, stay measured and resolute. And I was explaining this to a client the other day, and I thought it might be good to share here is, any impact, and you alluded to this, Wes, but any returns you get today, you're sort of borrowing from tomorrow, right? So if you were thinking, hey, my portfolio is going to give me 10% annually over the next X years, and we're up 20%, well, guess what? 10% annualized return is now being trimmed down to 8 or 9. So anytime we have these big rallies, it's very human nature. It's very consistent with human nature to be more optimistic when I think those are the times where you kind of sit back and want to be more measured and say, okay, how am I playing defense? What is my bond allocation? What are my reserves? Am I following the trends, or am I following the underlying backstop of the American economy? And so those are things we do behind the scenes, but I think it's helpful for folks to just remind themselves, don't get caught up in the fervor. I do think the valuation train will come to the station. Who knows when? I certainly don't. But yeah, that's the forward returns have certainly been borrowed from, I believe.
Brandon, final comments.
Yeah, I think just keeping in mind that there is value under the hood is just a little bit convoluted by some of these mega tech stocks. Um, and just being confident in that the long-term value or long-term investing approach does make sense even when valuations get a little stretched.
Right.
So stay focused on the long-term goals, stay invested, right? Don't move to cash. don't take your money out of the market, and just try to find those pockets of opportunity where they exist.
Well said.
Discipline, everybody. Discipline matters here. And in the long run, just staying disciplined and not having these emotional reactions with our dollar is a is probably the most powerful ingredient of long-term returns is just that discipline right there. And of course, we do a lot of tactical things for our clients. We're rebalancing, so shaving off what's done really well and buying what hasn't done as well, and therefore removing the emotions out of the process of buy low, sell high. We also do tax location. This is something I mentioned in a recent podcast. Tax location can earn an advisor's fee alone if you're placing the right securities, the right investments in the right accounts. And a tax-free versus a tax-deferred versus a taxable are very different in their time horizon and the tax nature on those different accounts. And it's the research has shown that somewhere around half a percent to 1% can annually over time can be acquired by just real good location of your investments across your accounts. We here have a software, it's called Tamarack, that gives us tools to systematically do this across all of our clients as well. So focus on the things that you control. This is what I want our listeners to really, really walk away with is there are things that you don't control and there are things that you do control. And the best thing that you can do to maximize the opportunity of return for your future on your invested dollar is to focus on what you can control. Keep investing. Live under your means so that you have a surplus every month to put into your accounts. Automate your savings accounts. Review your investments periodically, but avoid any wholesale movements. Meet with your financial advisor to hear an external voice, a professional on these matters, and keep investing. When the market falls, that should be the time where you're saying, this is the time I want to put more money in. If I can increase it more, great. Now, depends on what your dental practice is doing and how hard it's hit by any economic downturn. But to the extent you can keep funding that, the better, particularly around these 401ks and defined benefit plans where you're rerouting money that would be going to the IRS and you're putting it in your future pocket, your future self's pocket. That is such a key ingredient to compounded long-term growth. I can't emphasize that enough. And therefore, your consumption to income ratio matters. How much you're consuming relative to your income matters. And if you can get that consumption to income ratio down, that leaves more money to set aside for your future self. And final words here at Practice CFO, with all of our clients, each client is two clients. It's the client today and it's the client in the future. And both matter to us. We care about both and we invest for both. And we ultimately are trying to drive their assets to produce a good life. All right, guys, thanks for joining on this episode. We'll do another one in 3 quarters, see what's happening with the market at this point. Until then, have a great one.